Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that all of you are staying safe and healthy at this time. Today is going to be an amazing lineup. This week, the House voted and passed a 3.5 trillion budget resolution and advanced a 1 trillion infrastructure bill set to be voted on in late September. To kick things off, we have Melissa Labont, a tax principal out of our Arlington, Virginia office, here to provide insight on what's next and potentially on the horizon surrounding the budget resolution and infrastructure bill. We'll then bring in Jen Rowan to have a live Q&A on some of our technical Q&A employee retention credit questions. Welcome, Melissa. Welcome, Jen.
Hey, Matthew.
Before
Hi, Matthew.
Hey, how's it going? Before we dive in today, we have some housekeeping to cover. We have the ability for live Q&A during our session today. In order to participate, you must register and log in using the link below me. The questions will appear for you in the audience to see and like and move up in priority so that we can address them. We have moderators standing by ready to engage and interact with you. And once again, some of these questions we are going to have a live Q&A, so we'll be sharing these questions live as we proceed. On our next live stream, September 9th, I'm jumping ahead. Post our Labor Day holiday, we'll be having the next live stream. If you have any specific topics you'd like us to present on in the future or for that live stream, please share them in the chat. We'd love to hear. In addition to webinars, be on the lookout for articles and other white papers providing additional guidance. And as always, call your CLA relationship. We want to talk to you. Before we begin, please go ahead and smash that YouTube like button so that these resources can be shared with other subscribers. Melissa, let's get things started. There's a lot of activity on Capitol Hill. Can you please bring us up to speed?
Thank you, Matthew. As you mentioned, the biggest news this week is that both the Senate and the House have passed a budget resolution. That's the framework, the starting point for a reconciliation bill. Remember, this is the same process that Democrats used earlier in the year to pass that American Rescue Plan. So since it's going through reconciliation, they're not going to need Republican support. This bill can pass with only 51 votes in the Senate. That's assuming, of course, that all the Democrats come behind this particular package. Now, leadership's plan is to address just about all of the administration's priorities regarding social issues that were not taken up earlier in the year. So we might see stuff on pre-K for 3- and 4-year-olds, tuition-free community college, climate change, tax increases, and of course, much, much more. So what's next? Right now, since this process has started, we have about a dozen committees in the Senate, Baker's dozen in the House, all working on their part of that bigger package, right? So they have very high level instructions as to how much to spend and to what to spend it on. So they're coming up with the detailed proposals and it'll get sent over to the Budget Committee and then it's combined into one massive bill. So in addition to figuring out all the details behind what they want to include, what else are Democrats going to be trying to figure out in the next month or so? Number one is going to be the price tag. How much is the country going to spend on new investments? We know congressional leadership has said the max is going to be $3.5 trillion. But as I mentioned, they need 51 votes in the Senate. That means they can't lose any of their Democratic colleagues. We've already had some moderate Democrats from Arizona, West Virginia in particular. They've already come out and said 3.5 trillion, it's too much. They're concerned about inflation. They're concerned about the national debt. What they haven't told us yet is how much is okay. How much are they comfortable with? So we're going to be probably figuring that out in the next couple of weeks, perhaps months. Second thing that's still on the table, the net cost, right? So under the framework, that social package cannot increase the debt more than $1.7 trillion. That's the cap. Leadership, they're not going to hit that amount. They want most of it, if not all, to be paid for. So that's going to mean a lot of provisions regarding increases in taxes on corporations and individuals and families earning more than $400,000. We've heard over and over again, and don't see any reason why this is going to potentially change, that direct increases in taxes probably will not affect individuals and families making less than that $400,000 threshold. Again, though, all of this stuff just still needs to be worked out. Third thing that they're still going to have to figure out in the next month, I'm going to say anything and everything. The administration's plan early in the year, that's the starting point. That's kind of a wish list. Remember, of course, the administration doesn't enact law, Congress does. And they've been waiting many years for some of them to put their spin on things and to have their pet issues included. So we're going to be looking at and watching all the markups that are going on in both the House and the Senate very closely over the next few weeks. And some of the initial proposals released by the administration, some of them have already lost momentum. So they're likely not to get included. Like, for instance, limiting 1031 exchanges on real estate. That's starting to lose momentum. Or repealing the step up in basis for family-owned businesses. That also is starting to lose momentum within the Democratic Party. Other proposals that were not included in Biden's plan, they could all of a sudden show up and become part of this detailed bill. And I know Jen's going to talk about in a little bit, but a great example is the infrastructure bill that was passed by the Senate. They decided out of nowhere to repeal the employee retention credit for the fourth quarter. So we could still see surprises like that, even though maybe it hasn't been talked about earlier in the year. When they have last minute negotiations, provisions like that could show up. So what is the timing of all this? Under the reconciliation instructions, there is a September 15th deadline. That's what, a month from now, less than a month from now. Well, it's not binding and it's very aggressive. So our sources are telling us it's highly unlikely that it's all going to happen, that they're going to be able to pull together that massive bill by September 15th. But as part of the compromise that Speaker Pelosi made with some of the moderate Democrats to get them to go along and vote to get this reconciliation process started, she had to agree to schedule a vote on the infrastructure bill at the end of next month. So that's certainly going to come into play, given that leadership wants to bring both the detailed reconciliation bill as well as that physical infrastructure bill. They'd like to bring up those votes together at the same time. So there's going to be a lot of pressure for these different committees to pull their provisions together and get something moving as soon as possible.
Yeah, thank you, Melissa. Just one thing you mentioned there, the 3.5 trillion budget resolution and the 1 trillion in infrastructure bill, those amounts are caps, right? So that meaning they won't exceed those dollars when they resolve.
Yes, that's what I was talking about. That is they call it the top line. That's the cap. That it could certainly be less, but it certainly won't be more than that.
Okay. I know these are bold measures, so I think that might provide a little relief for those who are worried about inflation. Let's move on to the next piece here. Being proactive as an accountant is probably the most important thing we can do, the blocking and tackling, right? What proactive steps, planning, preparation, what would you recommend for folks who are seeing and hearing about these infrastructure bills? What should they do next?
My first recommendation, probably the best recommendation, is to have an integrated plan. Don't be just thinking about the business. Think about how it affects you as an individual. Think about cash flow, investments. And when you talk about taxes, you got to be thinking about self-employment taxes, income taxes, estate and gift taxes. You really need to be thinking about them all together because one really will affect the other. So take that all in consideration. And as you said, Matthew, be proactive. Ask your CPA questions now. A lot of people are just kind of sitting back and, well, I'll wait and see. At that point, it may be too late to plan. It may be too late to pull a trigger and have a transaction occur. So the sooner you have those discussions, the more opportunities there will be to make some changes and potentially plan before new legislation could be passed.
Yeah, thank you so much, Melissa. That's great information. I think this infrastructure package, there's a lot to do, a lot to think about. So if you are seeking or needing advice, please reach out to our CLA professionals. We're here to support you. Thanks again, Melissa. Let's bring Jen into the conversation now. Jen, you and I have been involved in the PPP, the ERC, but I think for a couple of the live streams, we really haven't had a a real good Q&A session where we could just focus on questions. So let's make that happen today.
Love
welcome,
it. Love
welcome
it.
to the chat.
It's I feel like I'm at like a carnival game, you know, like I'm either Zoltar in the box or like in a dunking booth. So depending on what you throw my way, we'll see how it gets how we get responded to. But it's exciting to be here, and I'm happy to have the chance to really dialogue with our audience and answer the questions that are either coming in through the chat or coming into us through the contact us button. We'd love to hear from everybody, but I feel like a lot of times we see duplicates of the questions because the same things are on everybody's mind. So let's do it, Matthew.
Yeah, let's
See
get
if I end up
started.
in the dunk tank by the end of it.
Let's get started. So we compiled a list of questions based on ranking from prior live streams. So let's tackle some of those. Let's start with the first one, Jen. Last year, if you qualified for the ERC 2020, you automatically qualified for the quarter after. Is that a true statement? And maybe can you clarify, the qualifying after you've already qualified
Sure.
for preceding quarter?
Yeah, sure. It's a great question, and one that has been the source of some confusion because remember, there are two ways that an employer can be eligible. One, because of the partial suspension or full suspension due to a government order. And in that case, an employer is only eligible for the full dates of the order. So in that case, if the order happened to end at the end of a quarter, you actually would not be eligible for the following quarter. Where the if I qualify in one quarter, do I qualify for the next situation comes in is when we're qualified using the gross receipts test. Now, the gross receipts test in 2020 is very different from the gross receipts test in 2021. 2021, the credit got more generous, except for in 2020, if in any quarter compared to the same quarter in 2019, you have a 50% or greater than 50% decline in gross receipts, you qualify in that quarter, and then you qualify for every quarter after until the quarter after your gross receipts rise above 80% of where they were in 2019. So in 2020, I know it's just a lot. So in 2020, once you hit that 50%, you're automatically going to hit it for the next quarter. It's possible that you'll even hit it for the following quarter. Now in 2021, you have to have a greater than 20% decline in gross receipts. If you hit that in one quarter, you'll automatically hit it for the next quarter. But then in order to be eligible for following quarters, you have to hit it again. So it's word soup when it comes to these numbers, but hopefully that clarifies, when we're doing the quarter after business, it's only when we're talking about gross receipts eligibility. In 2020, you have to have that 50% decline and you tend to qualify for multiple quarters thereafter. In 2021, it's really just that quarter and then the immediately following quarter.
Excellent. Excellent. Thank you so much. So it's only based on gross receipts if you're calculating the credit based on gross receipts. Okay.
That's right.
Here's another one, and I know this is one that we get all the time. I've submitted my 941X. How long is it going to take?
Well, that's such a great question. The answer is we don't know, but I can tell you what our clients have been seeing. I mean, we have done hundreds, if not thousands of these at this point. On the timely filed 941, we are starting to see those refunds flow in anywhere from 2 weeks to 2 months. So the IRS is getting more efficient with that. On the 941Xs, also we're seeing increased efficiencies now that the ball is rolling. So in some cases, you'll get your 941X refund back faster for, say, if you filed it for Q2 of 21 than anything that you filed in Q4 of 20. So the 2021s we're seeing coming in, or the 2020 941X refunds, we're seeing coming in anywhere from 5 to 12 months still. The 2021s, I mean, the earliest I've seen anybody get it is 2 months, but I think that's the anomaly. On average, it's probably closer to 5 months still. So I think that's a fair statement. And I could ask Melissa if anybody in her office has seen differently, but I'm guessing her answer would be affirming those windows as well.
Thank you. And I know I think it's the infrastructure package, the IRS is looking to hire. So I don't know if that's going to help, expedite a lot of these 941Xs if that is to happen.
I don't know if they're looking to hire to expedite refunds or to increase audits and maybe generate some cash flow, but We'll see.
We'll see where it leads.
Yeah.
All right. How about this one? We've received our ERC check, but the amount is less than what we calculated on our 941. How can we find out how the IRS calculated our credit, and what can we do to get the full amount we claimed?
Yeah, I mean, it's going to start with a phone call. What I would do, first of all, if you did the calc yourself, I would run it by your advisor and just confirm that you got the numbers correct. Then step two is just going to be to call the IRS, get a hold of that agent, understand the basis for the calculation, depending on what the difference, what's causing the differential, then you could take next steps from there. If you need help navigating that, I would definitely contact us or work with your advisor on that, because there are multiple reasons for that, and unpacking those complexities could, I mean, it could be the result of an underpayment in a prior quarter. I mean, there's a million different independent issues that would factor into that, but I would urge, one, a conversation with your advisor, and two, a call to the IRS just to see what's going on. Now, I understand it's difficult to get in there. Even the practitioner line is busy most of the time. So stay patient, do your best with it. Maybe call like right at the beginning, kind of outside of our normal business hours, maybe closer to the end of the day, just when volume slows down. But be patient with it. It may take a little bit to get through that. But it's a great question.
And staying on that topic, we just had a question come through our live stream, and they ask, are the ERC refunds coming via check or direct deposit, or is it both? Are we seeing both?
Check is what we're seeing. So no, I don't know if that's true for the timely. So for the 941Xs, it's a check. For the others, I believe, and Melissa, you can correct me if I'm wrong there, but the ones I've seen are coming back in the form of a check. I'm sure there's a way to deposit into the employer account if it's on the timely filed 941. But do you have different information on that?
Yeah, that's consistent with what we're hearing as well, Jen.
Okay, perfect. Thanks. You have the great just office, that interacts so well with the IRS and has some of that experience. So Matthew, when you hear me just reaching out to Melissa, I will tell you that our approach to ERC has been collaborative from the start with our National Tax Office. We've been leading with quality and just confirming everything that we as practitioners and specialty service advisors see with them from a quality and IRS interaction standpoint. And I think that's why a lot of times you're seeing our answers are consistent throughout. So I might keep throwing a couple at Melissa for affirmation as we do this. That way she can go into the dunk tank with me if needed.
Well, the ERC is a huge opportunity, Jen, and we want to make sure that all of our clients are eligible, are getting as much as they can. And so, yeah, we're taking those extra steps to make sure, because these numbers, some of them are quite hefty in a good way, that we want to make sure we maximize them.
Maximize the credit and minimize the risk, right? And so that explains our approach and why this has been, for multiple reasons, it's been really fulfilling to work together as a team. And I think our clients at least have come to know that from a collaborative perspective. That's how we approach this. So very fun. All right, Matthew.
Thank you.
Next chance to stump us, huh?
Yeah, thank you both. And you know what? We're going to do some collaboration on the next question. I think this is a good one to bring Melissa into.
Okay, cool.
Do you anticipate that Congress will change the requirements regarding amending 2020 income tax returns to reduce wages for employers who got back and filed for the ERC in 2020? So if you filed in 2020, 2021 for your 20 credit, and you filed your tax return, I guess the question is, do we need to go back and amend? And is the IRS going to provide guidance with a simplified approach?
Yeah, Melissa, I'm going to start this one and then have you come in behind me on this one. So notice 2021-49 that was released right at the beginning of August was very clear that is not going to happen, right? That it even addressed the fact that Consolidated Appropriations Act really only opened up the ability to claim ERC for 2020, kind of well into 2021 for many employers, and then the RevProc in some cases, because people weren't sure what to do with PPP forgiveness from a gross receipts test eligibility perspective for ERC, really only came out recently. The IRS notice 2149 was very clear that you are going to have to account for wages used for the 2020 credit on the 2020 income tax return. So my thinking is, because the notice already was very clear about that, it would be difficult to see the IRS come back and retrade on that. But Melissa, I would love to hear if you affirm or doubt that supposition based on your experience with the IRS coming out with restating their positions.
Yeah, I completely agree with you, Jim, but it does raise another little light bulb went off in my head. And that is, if we have major legislation, usually folks have a ton of questions, but keep in mind, legislation is usually very broad. We many times have to wait for Treasury to come in and issue regulations, and there will still be gaps. And that's when IRS comes in months, sometimes years later, and fills in all those details with notices. So although we'd like to have, answers as soon as possible, if we get legislation, kind of like what we saw with the employee retention credit, that guidance sometimes trickles in several months after the law is passed.
Good point. Really good point there. So thank you.
Yeah, thank you, Melissa. And we're going to direct the next question to you. And let Jen, if you want to jump in, by all means, please.
Sure.
Do you believe that the legislation will be passed to end the ERC, the 930, so the infrastructure bill I think we're talking about here? If it's not signed into law, do you think that 930 deadline for the ERC would be, pulled out?
First of all, I have to jump in and remind everyone that I knew Hillary Clinton was going to be president, and there was absolutely no way they were ever going to appeal the estate tax. So asking me to make predictions, I don't know, that's a great idea, Matthew.
Crystal ball is cloudy, Melissa.
Right. Yeah. What we do know, and that's what I'll share, is that currently it's in the Senate passed bill. Okay. House has not brought it up for a vote yet. It is scheduled towards the end of September to be brought up for a vote. There's going to be a lot happening at that same time, right? They're going to be thinking about a government shutdown. They're going to be thinking about reconciliation. And there's going to be so much in that package that I hate to say this one, detail may kind of fall through. Right now, if I had to take a bet, I would say it's in the Senate package. It's likely going to stay in the House package. But again, you don't want me making predictions. I guess I should talk about that second part, and then Jen, I'll ask for your thoughts on this. Will they change the deadline? Probably not. If something gets passed, let's say through the House on the 27th of September, gets signed by the president 28th, 29th, and the fourth quarter hasn't even started yet, I don't think that they're going to be pushing any deadlines. But I never thought that they were going to push back April 15th last year either.
That's true.
Yeah, Melissa, I would agree with you on that. I don't, as from the deadline standpoint, and I too shared your predictions in past elections, and so the current world we live in has not ceased to surprise me in the last decade, and so what we have right now is data, right? And the data is that is eliminated as far as the past Senate bill is concerned, and then we'll just commit to keeping everybody updated as we have more data. But Leslie made a good point when we were talking, and I would say, as always, she and I stand by this together, which is never let the incentive outcome drive the business decision, right? And that's something important to keep in mind if you're doing some planning, if you're a cash method taxpayer and you're doing some planning around invoicing to qualify, in Q3 with the gross receipts, assuming you already qualified and hit that eligibility perspective from Q2, so you're automatically qualifying in Q3. To go back to one of those earlier questions, maybe don't run yourself into any risky positions by manipulating things to plan for Q3 reduction in gross receipts, thinking that you're going to qualify in Q4 if there's a potential for it to go away. Make sure every decision you're making has a valid business reason. Do that anyway, because at this point, we know enough to know that it's not guaranteed to be here for Q4.
Absolutely. Once it's in a bill, it's harder to get it dropped because it's pretty far along the path already. And we talk about it being repealed for fourth quarter, but it's not repealed for all of the businesses, right? There are still some that might be eligible, Jen?
That's right. Those recovery startup businesses would still be in there to the extent that they qualify. And those, and I know we had some questions last week in the chat related to those. And, just a quick refresh. It's a business started after February 15th of 2020, with annual receipts of less than $1 million, looking back to the prior 3 years. So just something to keep in mind that would still be there, at least is proposed to still be around, even if in general the Q4 opportunity goes away.
Thank you both. That's very very enlightful. Let's jump this question to Jen. All right. Is a two-person S corp, both shareholders, eligible for ERC? And maybe can we also talk about relative wages as well?
Sure. So remember, a greater than 50% owner is not going to be able to use their wages for purposes of the employee retention credit. So a two-person S corp, depending on what the ownership percentage is, if it's 50-50, then yes, both owners could use their wages. Unless, and this gets to part 2 of your question, Matthew, they are related. And so the attribution rules are spelled out in section 51. And then nicely, we had notice 2149 come in to add spousal attribution as well. So essentially what it says is if you're a direct relative of an owner, then you can't use that person's wages, and that person's ownership percentage has to be taken into account too for everybody, right? So like if I'm a 45% owner and my child is a 10% owner, collectively we are 55% owner, and you could not use either of our wages. Now, if you have two spouses who are the owners, then in theory you'd hit 100% ownership, because again, notice 2149 spells out that spousal attribution rules apply unless the spouses are both neither, or I should say, if neither spouse has family members. So in that one very limited circumstance, both spouses' wages would be eligible for the credit. That's an odd random exception. It's been entertaining to read Chris Hesse, who's also in our National Tax Office, post about that. And there are a couple of people who are frustrated by it, but the clarity and for simplicity's sake, if you are a greater than 50% owner, either individually or by attribution with a direct family member or your spouse, any of those wages over, for an over 50% owner may not be included for purposes of the credit.
Thank you. Thank you. One more for you here. I'm kind of muscling through some of these questions. There's a lot. Did they change the 2020 definition of qualified wages at all for the employers with 100 plus FTEs?
They did not. So remember, there are a couple of steps in the ERC journey. First, you have to be an eligible employer, right? You either have partial shutdown or declining gross receipts. Part 2 is, what wages do we look at? So for those purposes, we have to look at headcount. Now in 2020, it's a less generous credit than in 2021. So what this question is getting to is, if in 2019 I had greater than 100 full-time employees, in 2020, when I look at the credit, I can only take the wages for those employees who were paid for not working. So not for being less productive, but literally the time that they are being paid and not working. In 2021, a threshold number goes up to 500. So that did change from the 2020 credit to the 2021 credit, but nothing in the notices or the legislative journey with consolidated appropriations or rescue plan came out to say anything about changing that 100-person threshold as it relates to 2020 credit.
Thank you. Thank
Sure.
you. And I had a really good one and I just lost it on the screen here. This one had to do with, let me see if I could find it here.
While you're looking, I'll say this is so much fun.
There's so many
Great
questions.
to hear
I'm like,
from everybody. I love this type of engagement. I mean,
yeah. I have filed Form 941 for second quarter 2021. This is a question on have they gotten their second quarter refund yet? And I think we answered that one, that it's 2 to 5 months, correct?
Yes.
About 2 to 5 months for the
Now,
refund.
if they timely filed it and they dropped the credit onto that 941, it wasn't a 941X. Like I said, we had a random anomaly where it was like a 2-week period and that check came back in. But for the most part, that one's like a 2 to 4 or 5 month period to be safe from a planning perspective. So it's a great question, worth repeating the answer for sure.
Yes. This was the question that I found, and I thought this was a little intriguing. And we'll close out. We'll close out on this one. What documentation needs to be attached to the 941X when claiming the ERC? And let's talk about more so the documentation that one should maintain to support their conclusion for qualifying for the ERC.
Okay, yeah, absolutely. So you don't need to actually include any of your supporting documentation on your 941X. It's just 5 questions. You'll need to tie it to your originally filed 941. But the bigger issue is, as you know, the American Rescue Plan actually opened up a 5-year window for the IRS to come back and audit and potentially deny eligibility for the credit. So the things that we advise, and we have all of our clients keeping track of, and we would, and it's fairly spelled out as well. So uniformly, we would suggest everybody do this. If you're qualifying because of a partial shutdown, keep the order, keep whatever documentation that you have to demonstrate that at least 10% of your business, whether it was your receipts in 2019 or your service hours, were impacted by that order. The closer to the time frame that you can write that down and document it, the much easier it's going to be and more reliable of a document that's going to be for the IRS when it's time to audit. Gross receipts, same thing. So make sure that you have your financial statements on a quarterly basis available and split apart for both 2019 and then whatever period that you're using to qualify for the credit. That's the first thing. With regard to headcount, again, those ACA reports, 941s, that's going to be important because, again, it's full-time employees, not full-time equivalents like you'd have for PPP. So definitely keep that in mind. And then just your 941s that you had, I would definitely keep on file as well. Those are going to be the key things. Obviously your credit calc, whatever you used. Now, if you had to pull your PPP wages or any family's first wages or WOTC or anything else from that credit calc, keep that documentation as well. Again, the cleaner your packet that supports the number that you put on that 941X, the better. So it's going to be eligibility, headcount, then of course, if you are a large employer, you'd want to have whatever support for the wages you paid to employees who were not working, how you came to that number, if they were salaried employees, how you got to the percentage, whatever you need, right? Like depending on your facts and circumstances, whatever you needed to get to that number, that support needs to be in place. And again, the sooner you can get all that organized and locked and loaded in the file, the better you are when it comes time for an exam. And then, like I said, finally, to the extent that you had to pull those other wages, health benefits, and other costs out of your ERC calc because of other programs, make sure you have your documentation for the other programs available as well. So that's what I would say.
Thank you for that response. That feedback was great. I think that was a great question. I think it's overlooked for both PPP and ERC. So make sure you've got support and you feel confident that you qualify. I think that's all the time we have for today. Jen, Melissa, it's been fun. I really love these live Q&As.
I feel like we could have gone for an hour. And I'm still dry. No, nobody got me in the dunk tank yet. I mean, we might get some emails after the fact, so we'll see. But but this is a lot of fun. So thank you so much for doing this.
Absolutely. All right. Well, please register and engage with us. We love hearing from you. We want to have a conversation. We'll see you again on September 9th. Have a good one.
Thank you.